Good morning, ladies and gentlemen, and welcome to today's webinar. The topic for today is Annual Operational Requirements for Entities in China and in Hong Kong. I would like all of you to know that the presentation will be distributed to all of you at the end of this webinar. In the meantime, if you do have any questions, please don't hesitate to write them in the questions section. It would be great if all of you could raise your hands right now so I can make sure that you can all hear me well. It's simply by clicking the hand bar. All right, then we'll get started. So as I mentioned, there will be a Q&A at the end of this webinar, and if you do have any questions throughout the presentation, in order not to forget them, please do write them in the questions section, and I will try to answer them at the end of the webinar. I will also be providing you with our contact details in case you would like to have some private questions answered at the end of the webinar. Just to introduce ourselves a little bit, Clayco Group is an international accounting and management consulting firm that was established in 1979 by the founder of the company, Mr. Klaus Kohler. Mr. Sven Kohler and myself are now managing the operations within our 10 offices in Hong Kong, Singapore, and in China. What we offer in terms of services is distinguished into two categories. One is corporate and business services, and the other is private client services. We assist clients at all stages of their market entry into China, whether it's in the pre-investment phase or whether it's post-investment phase. A little bit about myself. I joined Clayco in 2003 as the China Director, and am based in our Shanghai office, managing our 8 offices in China. I have been helping companies enter the China market, going through liquidation processes, M&A deals, etc. I've also been co-author with Klaus Kohler in terms of our ChinaInvest.biz magazine, which can be found on our website. Now, in order to start with the webinar today, basically I wanted to start off by simply saying pay close attention to all the laws and regulations in the jurisdictions that you are operating in. Now obviously this is not only associated with Hong Kong and China. I'm actually giving you advice anywhere in the world. Wherever you would set up an entity, you have to make sure that you are aware of what the laws and regulations are and what you are allowed and not allowed to do, and how you have to maintain your company. This is just a key tip that you need to be aware of. We have a lot of companies that inquire with us. They're more interested in the setup costs versus really analyzing and asking the questions about what needs to occur down the line when the company is actually established. So I will start off today's presentation with representative offices in China. I've listed here 9 key points that I will be going through that you do need to consider once the entity is set up, and what the annual requirements are in terms of operating and maintaining this entity. So although an RO is indirectly operational, it is still liable for filing and paying business tax, enterprise income tax, and individual income tax for the employees, as well as stamp tax, which is associated with the lease agreement that it signs. Now, this may sound strange, considering that a RO is a non-profit making center. However, the Chinese government does not require that tax to be paid, as they do require this tax to be paid because they consider that having an office in China, although it's not profit-making, it's still making profit somewhere else. And as a result, the Chinese government has several formulas which are used to calculate the taxes that are applicable for a representative office. In general, the tax rates range from between 10 and 15% based on the expenses. So this heavily applies to point number 1. Keep financial statements and receipts in good standing order and up to date in order to be able to declare your tax declarations. The annual audits have to occur at the end of every year. So even though you're not profit making, the annual audit is associated with the expenses that have occurred throughout that year. The annual audit, there are 2 types. One is for the foreign currency account that a rep office will have, and the other is for the financial statements audit report. Both audit reports must be completed prior to April 30th of every year. Now, point number 4, choose your auditor wisely. Now, Click or Group, for example, we are not permitted to perform annual audits in China for the main reason that we are a foreign invested company. Now, there are many companies out there in China that will say that they can do audit reports. Please do check whether they themselves are physically doing it or whether they are outsourcing it to somebody else. Another thing you should be aware of is that the tax bureaus every year have an updated list of auditing firms that have been blacklisted over the year. So it's very important also prior to choosing your auditor to make sure you have a discussion with your tax bureau to make sure that you're not choosing a firm that is actually blacklisted and the tax officer won't even accept the audit reports. So again, choose your auditor wisely. The annual individual income tax filing and the annual profits tax filing are required on the basic principle that if too much or too little tax has been paid, then the annual filing will clarify this. Usually, if not enough tax has been paid, then you will be asked to pay it at that point of declaration. If too much tax has been paid, the tax bureau will provide a credit so that in the following year, in your first quarter tax filings, less can be paid. A new regulation, which has been implemented as of March 2011, is the annual inspection of a RO. Now, this is a required application to be made and submitted between March 1st and June 30th of every year. One of the documents which must be submitted during this annual inspection is a copy of the audit report. So the audit report must occur prior to the annual inspection. In addition to that, during the annual inspection, the parent company documents must be once again notarized by the Chinese embassy, or in the case of Hong Kong, by a China designated notary, which all takes time. So you have to make sure that when it comes to your annual maintenance requirements, that these are done in time, in order, and that there are no delays. Should the application be submitted 1 day late, the RO will be automatically stricken from the computer systems of the government bureaus. The annual inspections are not to be taken lightly. These are really due latest by June 30th. And again, you have to be very aware of time frames, how long everything takes. In China, everything is about paperwork and time. So do get a head start. It's already December. Try and choose your auditor already now. Make sure that your financial statements and receipts and tax declarations are up to good standing so that immediately in January you can get started with these annual requirements. Point number 8, registration certificate renewal. This has been, the regulation has changed over time. As of today, depending on where your rep office is actually physically located, you might be lucky in that your registration certificate has an undetermined renewal date, meaning that you don't have to renew the certificate at all. In other cities, you will have to renew it on an annual basis, every 3 years or every 5 years. And point number 9, any changes that have occurred within the RO. These always have to be updated because during the annual auditor, if you do have a proper auditor in place, the auditor will request to see these changes occurred on all the certificates. So if you changed the chief representative, if you've changed your address, if you've changed your business scope, these all have to be shown and updated in your certificates and then provided to the auditor so that they can put it inside their reports. Limited companies in Hong Kong. Now, most of you might suspect, or limited companies in China. As most of you would have guessed, there are many more things that actually need to be done, but they're all very similar to representative offices. So, a limited company is liable for filing and paying profits tax, business tax, value-added tax, customs duty, and stamp tax, as well as the individual income tax for employees. Now, there may be a further series of taxes that have to be paid and declared depending if you own property, if you are trading in luxurious goods, then there is consumption tax, etc. So you have to be aware of what taxes your company is actually liable for paying. It is therefore required, especially for limited companies, not necessary for rep offices, that the company has an approved accounting software system to conduct the monthly bookkeeping and to create all the government-required financial statements and tax declarations. Now, obviously, the accounting documents and financial statements must be all in Chinese. There is one very good software system called King D, which is an automatic bilingual software system and can be purchased in China very easily and installed very easily as well. And you can add certain modules at a later date. So at least if you have your general ledger to begin with, accounts receivables, accounts payables, you can add inventory at a later date. Annual audits for foreign invested enterprises. All FIEs in China are required to prepare annual expense sheets, financial statements, which include balance sheets, income statements, for their annual Chinese audit. And such accounts must be in accordance with the Chinese GAAP system. Now again, as I will say from the rep office, choose your auditor wisely. Choose the right auditor for your company. Companies, including their legally responsible persons, so this would be the legal representative, must take full responsibility for the truthfulness, legitimacy, and completeness of these financial statements. So having said that, make sure you also have a proper accountant in place who's doing this work for you. The financial statements must be completed each month for each financial calendar year. The fiscal year in China is fixed from January 1st to December 31st. And this cannot be changed unless you are a multinational company and you want to fix your fiscal year according to your parent companies overseas. If you're an SME, you're stuck, you're fixed on this fiscal year calendar. The documents must be completed and audited by April 30th of the following year. The audited accounts will then have to be consolidated and submitted for tax purposes also by the end of April of every year, and this is for the annual profits tax filing. These statements will be used for computing the taxable and distributable profit. An audit by a firm of certified public accountants registered in the PRC is required under Chinese law. So I have had many companies ask me, since they have holding companies in Hong Kong and then entities in China, whether they can just use their auditor in Hong Kong to do the audit for China. They can only use this type of auditor if the Hong Kong auditor has a firm, a registered firm in China. Otherwise, it's not permissible. In addition to that, you should use an auditor that's located in your city, because then your auditor will be fully aware of the formats of the audit reports and what the tax bureaus are actually looking for. Don't use an auditor in Shenzhen if your company is located in Beijing. It just doesn't make sense in that regard. Foreign companies will also need to submit to both the National Tax Bureau and Local Tax Bureau the Annual Taxation Consolidation Reporting Package. Now, I know that's a bit of a mouthful, but this is a series of documents which must be completed in order to verify the taxes that have been paid by the company. So in this reporting package, the auditor will verify all the taxes, including VAT, business tax, consumption tax, if this is applicable, income tax, all the taxes that the company is actually liable for paying. The most important aspect which needs to be filed in this report is the income tax. Obviously, this is associated with the cost of goods, expenses, etc. If the audited taxes are different from the taxes paid by the foreign company needs to discuss this variation with the Tax Bureau. Just for an example, should the audited tax figure be lower than the figure paid, the foreign company will need to apply for a tax rebate or tax reduction for the fiscal year in question. Accordingly, should the audited tax figure be higher than the paid income tax, then once all these reports are submitted, it will have to pay the balance due to the Tax Bureau. Annual license renewals. Besides an annual audit, limited companies also have to submit a range of other documents and licenses to the authorities for checking and for renewal. The so-called annual renewal is a very bureaucratic process for limited companies, but it is a good time for all of you to ensure that the paperwork is up to date. And it's a way of testing your staff to make sure that the documents are up to date. The audited financial report, the foreign exchange audit report, and the annual report, which is the annual renewal license report, must be submitted to 7 different government departments. And these must all be submitted no later than June 30th of each year. Annual inspections for limited companies. This is different than annual license renewals. Limited companies need to apply for and obtain the annual inspection documents from the same office that they applied for the business license, which is the State Administration of Industry and Commerce. They must also complete the annual inspection report form on the website of the SAIC. So as you can see, there's a lot of paperwork that needs to be done for limited companies. Generally, it's your accountant that will be handling this work for you, and you've got to make sure that all the work is done. It's a great way to find out if there are any discrepancies within your entity. So be on top of this, as this is really the point where you should be looking at your results for that fiscal year and making sure everything is up to date. I want to go into more detail here regarding the annual individual income tax filings for expats and mainland Chinese. This is required whether you're employed by a rep office or whether you're employed by a mainland Chinese person. To give you a bit of a background, all employees in China must declare their personal income taxes on a monthly basis. If you're working for a foreign invested company, usually the company will make these declarations on behalf of the staff. The annual income declaration, this is only applicable to individuals that are earning more than 120,000 RMB on an annual basis, which is 16,200 USD. If you're earning less, you do not have to fill out this annual individual income tax form. This is a self-declaration. It's not the responsibility of the company to complete this form, but if you are a foreign company, it would be wise to make sure that your staff that are earning above 120,000 RMB are completing these forms and getting it done. The forms must be completed by March 31st each year at the latest. And it's an annual self-declaration form, which basically means if an employee is earning income outside of its monthly salary, it needs to be declared. And this can be in the form of royalties, dividends, rental income, etc. This all needs to be filed in this form. Dividend distribution. The accounting year, as I mentioned, runs from January to December in China. It is therefore important in November, December, so now, to start planning for the declaration of dividends for repatriation and or reinvestment of profits. Repatriation of profits, so dividends, can only be done once a year in China. Usually the process is that the audit report must be done first. The annual profits tax filing, annual inspections, and business license renewals must all be completed. At that point, the dividend distribution application can be started. Generally, this is then from July 1st onwards, and the application takes about 6 to 8 weeks to get approved. At that point, there is a dividends tax which will need to be paid. If your holding company is based in Hong Kong, there's a 5% dividend tax. If it's in Singapore, it's 7%. And anywhere else where there is a double taxation agreement signed, it's 10%. And finally, any changes that have occurred within the LTD throughout the year, you've got to make sure that these have been applied for and all certificates have been updated and changed. This goes for the change of legal rep or even anybody in the corporate structure of the entity, so board of directors, legal rep, GM, supervisors. Whether you've changed your business scope, whether you've changed your registered office address, whether you've increased your registered capital, all of this information has to be updated with every single government bureau, and all of this information is on every single certificate that you've had issued when establishing the entity, so all of these have to be updated. And Hong Kong companies. Well, as many of you probably already know, the general route to entering the China market is by establishing a Hong Kong holding company first. First of all, there are tax benefits that are associated with this, but the most important is the dividends tax, which is only at 5% when repatriating dividends from China to Hong Kong. As with anywhere else, you do need to have a sound accounting software system in Hong Kong. You have to make sure your financial statements and receipts are in good standing order and up to date. If you are handling transactions via your Hong Kong company, for every single transaction that is running through the Hong Kong company, every single piece of paper must be accounted for. So if you are trading, this would include packing list, bill of ladings, all shipping documentation, invoices, contracts, etc. So what you need to think about on an annual basis. Let me start off with the fact that in Hong Kong you can choose your fiscal year. Generally, our clients that have China establishments, they will choose January to December as well for their Hong Kong company, but this is not mandatory. You could also have a July-June fiscal year if you would like. The annual return, this is usually always mixed up with the annual audit. The annual return, all local companies incorporated in Hong Kong under the company's ordinance are required to file an annual return, and the filing deadline is within 42 days after the anniversary date of the incorporation. The annual return is basically a document which is verifying the corporate structure, the company secretary, and the registered office address of the entity. The annual return needs to be manually signed by at least one director of the company or the company's secretary and submitted to the company's registry. Every director, company secretary, and manager is liable for late filing, and the maximum penalty for breach is 50,000 Hong Kong dollars and a daily fine is 700 Hong Kong dollars. So you have to make sure that this annual return is done and it's done in time. The annual audit, similar to China, every financial year each Hong Kong company is committed to file an annual audit. This annual audit must be presented to the shareholders at the annual general meeting and submitted to the IRD together when filing the profits tax return. This audit has to be done in accordance with the Hong Kong GAAP system and done by a certified public accounting firm. So in Hong Kong, we do have this capability. We can issue audit reports. An annual report consists of 3 parts. So the annual audit report consists of 3 parts. The director's report showing key information concerning the company, the annual accounts showing an overview of the annual statements, and the auditor's report which states whether the P&L and the balance sheet exhibited are true and a fair view of the company's financial position. The annual general meeting must be held within 18 months after its incorporation and once a year thereafter. So basically in every calendar year. The annual profits tax application, every Hong Kong company has to file its profits tax return on its profit arising in or derived from Hong Kong. The profits will be taxed at 16.5%. Each year, the company will receive a letter from the IRD with an application form. The filled in and signed documents will be sent back to the IRD together with the audit report and the tax computation form. This form, together with other supporting documents, needs to be handed in to the IRD no later than 1 month after the letter from the IRD was issued. Otherwise, penalties up to 3 times the tax payable may be charged. You can file for extensions, so this can be noted. The annual tax exemption application. So basically, once the company receives the request of the IRD to pay its profits taxes, it can either fill out the form and pay the 16.5% profits tax, or it can file a formal letter to the IRD applying for the tax exemption. So usually what happens with our clients is that we will do the annual audit report. We will tell the client, listen, going through all your documents and all your transactions, it's fair to say that you won't have your annual tax exemption approved. We therefore think that you should apply for the annual profits tax. Or we will say to the client, yes, we think that you will be approved for the annual tax exemption. You should go this route and file the application. The IRD will then send a letter back with extensive questions in order to assess whether the company's demand can be justified, or they may request that the company provide full documentation of several or all business transactions running through the Hong Kong company. This is why point 1 and 2 are absolutely important and vital if you want to apply for the tax exemption. You have to make sure all documents are readily available and are properly filed in order to be able to justify your tax exemption application. Depending on the profit the company generated and basically the complexity of the business, the offshore claim can actually take up to several months, if not years. We've had some companies where we're still in the process and it's been close to 2.5 years that we're still on that fiscal year applying for the tax exemption. So it's a process that is not just guaranteed and given the minute you submit the application. It's a thorough process that's initiated by the IRD, and naturally it's common sense. The IRD doesn't want you to evade taxes. So they're going to check all the documentation to make sure that all the criteria are fulfilled, that you can then apply for the annual, that you can then have the annual tax exemption approved. The annual personal income tax application, this is different compared to other countries. Personal income tax is paid once a year, whereas in China it's paid on a monthly basis, and it will not be automatically deducted from the salary. Each person is responsible to file the application. The company is not liable to conduct this filing. So every person working for a Hong Kong company that is more than 60 days in a year in Hong Kong is liable to pay personal income tax. in Hong Kong. The standard tax rate is 15% of the annual income, and depending on your status, if you're single, married, you have children, there are certain allowances which are deductible from your annual taxable income. Statutory requirements. Every company in Hong Kong must have at least one director and one shareholder, which can be the same person. It can also be a company, and Hong Kong residency is not required. You must have these people in place. So if you want to change a director or change a shareholder, you have to have a replacement readily available. In order for the government to have a contact person in Hong Kong, each Hong Kong company needs a corporate secretary, so company secretary, and this must be appointed at the point of establishment of the company. This person can either be an individual who ordinarily resides in Hong Kong or a corporate entity which has its registered office or business place in Hong Kong. A registered office address in Hong Kong is a must as well, but unlike in China, where in China one office is for one company, in Hong Kong you can have as many companies located in one office address. Hong Kong companies must keep its normal statutory books, such as the register of members and transfers, together with minute books of the meetings of its directors and shareholders. It is important to note that proper accounting is essential in fulfilling all the annual mandatory requirements in an efficient and easy manner. And I want to point out again, this is particularly necessary for the annual tax exemption application. Without proper accounts, the company could really be at risk for penalties, for late filings, no filings, etc. In Hong Kong, you can negotiate like you can in China, but in Hong Kong, they're less inclined to negotiate. So this is also something to keep in mind. Make sure that you reach your deadlines in time and that everything is done accordingly. So here's time for Q&A. If you do have any questions, please add them into the questions section of the panel. Basically, I wanted to sum up as well the presentation today. There really is no reason for foreign investors to be nervous or hesitant about establishing their entities in Hong Kong or China. Yes, the annual regulations are tedious, but I am sure they're just as tedious as if you were to set up an entity in Europe or in the US or in other locations. The key for many investors, and I guess where I see many investors go wrong, is that they become excessively complacent, and in order to avoid fraud and to avoid non-compliance issues, you cannot be complacent. Be on top of your staff, ask questions, and be aware of what actually every step requires. To give you one example, many people assume that by just doing the tax exemption application once, you have this status for life. You don't. You have to do this tax exemption application in Hong Kong every year for every audit report that is issued. Why? Because all of a sudden you might be doing 1 year offshore business and the next year onshore business. And the tax bureaus, the IRD, want to verify that actually you're not evading any type of taxes. So don't be complacent. And many of our clients, they choose service providers to handle these ongoing issues for the main reason that there is a third set of eyes on the company and there's an outside perspective on what is actually physically going on. These service providers, in theory, should know exactly what is required when maintaining an entity in China, and they should be advising you on the necessary steps that need to occur. So this can be in the form of an accounting firm, consulting firm, law firm, but get your advice from outside parties. Don't always rely on your staff. So that's the end of our presentation today. If you do have any questions that you would like to have privately answered associated with your entity alone, please don't hesitate to contact us. You can reach Sven, who's based in our Hong Kong office, or myself, who's based in our Shanghai office. I hope that you all enjoyed today's presentation, and I look forward to seeing you all again soon. Thank you and goodbye.